Welcome. Good morning, good afternoon, wherever you are. I'm going to do today's session on P&Ls, profit and loss reports. If you're a non-finance manager, if you head up a non-finance team, you are for sure seeing P&Ls come across your desk. They can be tricky, they can be intimidating, they can be threatening. A lot of finance managers express a fear of not truly being able to understand the P&L, not truly being able to read it, not truly being able to interpret it. So in this time that we're going to spend today, we're going to unpack what a P&L is, the structure of a P&L, the story that the P&L tells, what changes we can make to the P&L to improve profitability, and we're going to look at some ratios. So welcome, stick with me, and hopefully in the short time we have, we will make a lot of sense of P&Ls. So let's start with some P&L basics. What are the components that are even in a P&L, and what information does it convey? So I'm going to share my screen of my gamified approach to teaching finance, and we'll make more sense of it this way. So you see over here, and let me see if I can zoom in, we have the top part of this being our balance sheet, which we spoke about in our last session. Assets, liabilities, equity form the balance sheet. Now this bottom part, income and expenses, form what we call the P&L. So anything, and obviously if income is more than expenses, we're making a profit, or if expenses more than income, we're making a loss. Let's actually show that live. So let's create an account here in income, and I'm going to drop an amount into income, and you're going to see a profit piece pop out. So there we go. At the moment, when income exceeds expenses, we're making a profit. Or the other way around, let's get rid of that. When expenses exceed income, and let's drop an amount into that expense account, we're making a loss. So we're only concerned with these two sections of what we call the general ledger. Assets, liabilities, equity, income, and expenses is the general ledger, or the GL. The P&L is only concerned with these two bottom components, income and expenses, which will result in either a profit or a loss. Okay, so that's now some P&L basics and understanding what a P&L is and the components of a P&L. Now we're going to go a little bit deeper. What qualifies as income? And I'm going to put a question out there. So let's see. I'm going to share a question. Can we be making a handsome profit yet have no money in the bank account? Okay, so pop your answers in the chat. What do you think? Can we be making a handsome profit yet have no money in the bank account? Pop your answers in the comments, because this key question that so many non-finance managers struggle with is really the key to understanding a P&L. If you can answer this question with confidence, you for sure understand a P&L. If you struggle to answer this question, or you're not really sure, we've got some work to do. So let's explore. I'm going to jump you back in to the app, and let's try to answer this question visually in a gamified way. Okay, so here we go. This is the screen that we spoke of before, where income and expenses were our P&L. Now, let's represent a scenario where we sell something. Okay, so let's find this transaction. We sell some goods, and or let's make it even easier. We sell a service, we consult to a company, and we bill them consulting fees. So how would we represent that transaction? We would record the income, and let's say the bill was for $8,000. And we would call that um, consulting fees. Some companies would call it revenue. So we have earned income. We have no expenses. We've made a profit. But have we received the money? I just said we billed the company that we consulted to, but we didn't receive any money. So we know that in accounting or in finance, there's two things that happen at any point in time. It's your debit and your credit, which we're representing in red and blue. I'm going to have to put the blue, because right now I have a blue that I'm not sure where it goes. We're going to have to put that blue in an account called accounts receivable, which basically is a fancy way of saying we own the right to collect that money from the customer that we billed. And so there you see, we have income, we have earned income, yet we don't have any money. We have an IOU. We own the right to receive that money from the customer. So we're making a profit. We have a profit of $8,000, but we have no money in the bank account. And let's say now that we have some sort of expense, okay? And let's account for the fact that we received a February invoice from a service provider for telephone and internet. So we're going to have a telecoms expense here in expenses. And I'm going to pop $1,800 into that, $1,800. But have we paid that? No, we're only going to pay it next month. It says here, receive February invoice from service provider for telephone and internet. Invoice will be settled in March next month. We're in February. So we're going to put that red amount in accounts payable, reflecting that we owe the supplier. Great. And there you see we have made a profit. So our profit would be $8,000 less $1,800. So $6,200 would be our profit. Has any money come into our bank account? No, we don't even have a bank account. I haven't even created a bank account yet. There's our bank account. There is zero in our bank account, yet we've got some inventory, we've got some equipment, we've got some accounts receivable, but we have zero in our bank account. But yet we have a profit. We have a profit of $6,200. So this should answer your question. Of course, can we earn a handsome profit and have no money in the bank? Yes, we can, and we just demonstrated that now. But how can that be? And in answering this question, this is key to understanding a P&L. If you think that income is about the money we received in a period, you are incorrect. Income on your P&L or your revenue or your fees or your turnover item on your P&L under income does not represent the money you received this period. It represents the value you invoiced this period. Okay, so we invoiced $8,000. We made a sale to the tune of $8,000. We sent the invoice to the customer. We've delivered the goods. We record the income. And that is what income is. And it's important to understand. We call this revenue recognition. When do we recognize revenue? We recognize revenue when we've rendered the service, when we've done the work, we've invoiced the customer, we've delivered the goods to the customer. We record the income or the revenue or the sale on the P&L, even though no money has been received. And I showed you that again, just to recap. $8,000 went into consulting fees revenue, and $8,000 went into accounts receivable, showing that we own the right to collect that. So we don't have to have received the physical cash for it to count as income on the P&L. And the same would apply with expenses. We don't need to have spent money for something to qualify as an expense. We only need to have used it. We only need to have used telecom services worth $1,800 in order to account for it as an expense, as we showed here. $1,800 telecoms expense, and our red or our credit went into an account called accounts payable, showing that we haven't paid that yet. We owe it to the service provider who provided us with that telecoms for the month. And so using this gamified approach, I hope I've illustrated to you clearly how one can make a profit or a loss on the P&L without the bank account being touched. Why? And let's just summarize here, because income is not about money being received. Income is about the value of service we rendered or delivered in a particular month or period. And expenses is not about money paid out. Expenses is about the usage that we used in a particular period. So that is what income is, and that is what expenses is. So once we understand what our income and expenses are, we can understand that one can make a profit or a loss without the bank account being affected. So now that we've laid down those basics, we can jump into a real life P&L, and we can start making sense of it. So if this is resonating, and if you have non-finance teams that desperately need to make sense of their P&Ls and need to understand them, need to interpret them, need to analyze them, just pop the word P&L in the chat, and I'll be happy to reach out after this live and tell you more about the courses we offer to help non-finance teams understand their P&Ls. So let's show a real life P&L now and make sense of that, because now that we've seen the gamified version, we'll understand a little bit more when we're looking at a real life P&L, how that comes to be. So let's pop open a P&L. So there we go. Profit and loss statement, P&L for the year 2024. Okay, so we have here, and I'm going to zoom out a little bit so we can look at the whole P&L. So we have here sales, less cost of goods sold, gross profit, operating expenses, income before tax, net profit or loss. So what are the main things of the P&L that we need to define and understand? So I'm going to zoom in and I'm going to highlight them. The main things we need to understand on the P&L are sales. What exactly does that mean? So let's stop there and let's make sure we understand that from the last thing I explained on the game that I was in, that sales represents, this is the value of actual sales invoiced, not money collected. Okay, and we saw that you record something as income, you record something as revenue. We could say sales, revenue, fees, whatever you'd like to call it. This represents what we've actually invoiced in service, not what we've collected in money. So that is our sales on the P&L. Cost of goods sold. So this you might see under the acronym COGS, which stands for cost of goods sold. Some people call it COGS. That is your cost of goods sold. You might see it also written as COS, which is cost of sales. Now, what is the cost of sales? Cost of sales is what it cost you to deliver the service that you delivered. So, for example, if we ran a shoe store and sold a pair of shoes for $100, which we purchased from our supplier for $50, so the cost of sale would be $50. So it would be $100 in revenue, $50 in cost of sales, and our gross profit would therefore be $50. So cost of goods sold simply represents the purchase price of the inventory through which you purchased it for, and that represents cost of sales, giving us then gross profit. So gross profit is simply a subtotal where we take our sales or our revenue, we deduct our cost of goods sold, and that gives us what we call gross profit. Now, cost of goods sold, we would call a direct expense. And what is a direct expense? A direct expense means that it only happened, that expense only happened as a result of having made the sale. Without having made the sale, we would have had no cost of goods sold expense. So rent or salaries or insurance, they're unrelated to making the sale. So those would not be direct expenses. So where do all those other expenses come? They then come down here under operating expenses. So this is where we would have our salaries and our rent. What else? We would have some insurance. We would have telecoms. We would have water. We would have electricity. Advertising, transport. So these would all be operating expenses which are unconnected or disconnected from the sale itself. Any expense directly related to having sold the goods would be recorded what we call above the line there in cost of goods sold. So we explain now operating expenses. When we deduct operating expenses, we are left with a new subtotal, income before taxes. Great. Then we deduct tax, $50,000, to give us our net profit or loss after tax. So that line, you might see it as net profit after tax. Some companies use accountants, finance people love their acronyms. Okay, so NPAT, some companies call it. So that would be your net profit after tax. And we split expenses in this way. Obviously our cost of sales or cost of goods sold, which would be our direct expenses, and our operating expenses, because this allows us to see, to have a better idea of where things are happening and where we need to make changes and where we need to fix, and it gives us better information when we split our expenses into direct and into operating. So those are the main items that you need to understand when looking at a P&L. You need to understand, let's recap, let's summarize, that your sales line in the P&L is not your money that you spent in a period, but it is the value of actual sales invoiced. Okay, services rendered, sales invoiced in a period, not necessarily that we've collected the money. And again, the P&L could be for a month. A lot of companies, most companies produce a monthly P&L, or it could be for a year. It could be your yearly P&L. Okay, it really doesn't matter. Just know that that number, that sales number, does not tell us how much of that sales has actually been collected in money. And this is something known as accrual accounting. We account for revenue when we actually do the work and not when we receive the money. Okay, so let's go to the next line, cost of goods sold. We said that was the cost that we purchased the goods for from our supplier, and that was the cost that was sitting in inventory before we removed those goods out of inventory and moved them to cost of goods sold, and that is an expense. Okay, so cost of goods is an expense. And let me actually show you that in our app again. I'm going to jump back into the app, and let me share the app again to show you exactly how cost of goods sold works, because that can be confusing. So let me leave you with some clarity on that. Every time we make a sale, we would take out of our inventory, and this happens every single time. Here we go. Stock sold had a cost of $2,500. So what do we do every time we make a sale? We remove from inventory $2,500, and then we create an account in expenses called cost of goods sold or cost of sales, and we drop in $2,500 to show that that $2,500 has left our inventory and is now moved into cost of goods sold. Okay, as a result of having made that sale, we're no longer holding on to that inventory. That inventory has been sold, it's gone, and we record an expense. So that is cost of goods sold. And let us go back to the actual P&L and just summarize and make sure everyone has super clear what the different line items mean. So we've spoken about revenue. We've spoken about cost of goods sold. Gross profit, difference between revenue and cost of goods sold gives you gross profit. There is a ratio here, which a lot of companies look at, which is called the GP percentage or the GP margin. And what is it? It's taking your gross profit and dividing it by your revenue. So let's do that. Gross profit divided by your revenue. So let's work out the GP percentage here. And obviously we times it by 100 to get it as a percentage. So your GP is that 200,000 divided by 500,000 times by 100 to get it to percentage. So 40% GP percentage or GP margin is what we have in this sample P&L that we're looking at. So that is an important metric to measure on the P&L. Your GP percentage. What percentage is your gross profit margin of total sales? Then we said we had all those operating expenses which were disconnected from the sale and gave us total expenses. When we took gross profit less our total expenses, 200,000 minus 40,000, we were left with income before taxes of 160,000. We take off tax separately because really the company has no control over what is taxed. It's an amount that is decided by the government. So we take off tax separately and show it as a separate line item to get to a net profit after tax of 110,000. Then we can look at more ratios over here. We can look at our net profit margin, which would again be our net profit divided by our sales. So let's calculate that number, 110,000 divided by 500,000, and obviously we times by 100. So our net profit margin would be 22%, whereas our gross profit margin is 40%. And once we understand what the P&L is, that all these expenses that you're looking at doesn't mean you've necessarily paid them. It means you've used them, right? That it's been used. Most likely it will be paid at some point. But it doesn't mean that those have necessarily been paid. Some of them might have been accrued for. Some of them might be sitting in accounts payable. But these expenses represent that this has been used. We have used staff to the tune of 5,000. We have used office space to the tune of 5,000. We've used insurance to the tune of 5,000. Doesn't necessarily mean that it's been paid. And that's the important thing when looking at your P&L. Noting that you're looking at essentially a statement of movement of things, services we've rendered and things we've used in order to give us a profit or loss. Have the services we rendered be more than the things we used, or the things that we've used be more than the services that we've rendered? So I hope that's given clarity to some of the main items. And when you look at your P&L now, you will see that sales, value you invoiced. Cost of goods sold, that's the actual inventory cost that has now been expensed, as we showed, moving that down from inventory to cost of sales. Gross profit, difference between the two, revenue and cost of goods sold. All your other expenses, salaries, rent, insurance, telecoms, and more, those expenses have all been used, not necessarily paid yet, probably will be paid very soon, but doesn't mean they've been paid yet because they appear on your P&L. Just reflects that you've used that particular thing, giving you income before taxes, 160,000. We take off tax, then to get to net profit after tax. So when you're looking at your P&L, I hope those line items now make a lot more sense. You understand what you're looking at, you're understanding the story that it tells. And now, once you understand the story that it tells, you can start seeing, where do I make improvements? Where do I make changes? Where can I pivot to drive profitability? And this is, again, next level. How do we impact the sales or revenue line? Well, we can sell for higher prices. How do we impact the cost of goods sold line? We can buy better from our suppliers to make sure a smaller amount moves down from inventory to cost of sales. We can get better deals and better terms from our suppliers. How do we reduce our operating expenses? Well, we get rid of any excess expenditure. There might be staff who need to be made redundant. We might be able to rent a cheaper office space. We might be able to get better insurance cover. We should shop around for telecoms providers, etc., etc. We could cut down on operating expenses, and that in turn would obviously improve profits. Tax, you can't touch that one, decided by government. Percentage of your income before taxes will always go to tax. But we can see now where are the parts in the P&L where we can play a role to cut expenses, to drive revenue harder, to come out at a better and more profitable situation at the end of the period or at the end of the year. So I hope this has been insightful for you, that you've learned about P&Ls, that you've learned the structure of the P&L, that you've learned what the line items on the P&L mean. And I'm going to put up here, if anybody wants to reach out to learn more about our courses that we offer to help non-finance staff understand P&Ls, interpret P&Ls, analyze P&Ls, and help drive profitability within the business, you can visit www.accountingmadeeasy.co, or you can just DM me. Have a wonderful day. Thanks for listening. Thanks for watching. See you soon.